So, Palantir just dropped their third quarter earnings, and the headlines are absolutely glowing. But if you look a little closer, you realize there are two totally different stories being told. On one hand, you have this incredible success story from their earnings call, and on the other, a much more reserved, much more cautious picture painted in their official SEC filing. Let's break down what's really going on.
So where do we even begin? Well, how about with this quote from CEO Alex Karp? He's not just saying they had a good quarter. He's claiming it's, and I quote, arguably the best results that any software company has ever delivered. That's a huge statement, right? A pretty bold claim, so let's see if the numbers actually back that up.
And that's the big question, isn't it? When you hear hype that big, you have to look past the headlines and get to the real story. So let's dig in.
Okay, first things first, let's get into the numbers that have absolutely everyone talking. We're going to deconstruct this record-breaking performance piece by piece.
All right, first up, the big one, 63%. We're talking 63% year-over-year revenue growth. I mean, for a company of Palantir's size, that is just a massive leap. It completely blew past all expectations. But believe it or not, that's not even the most jaw-dropping number here.
So you're probably wondering, where is all this growth actually coming from? Well, a huge piece of the puzzle is their U.S. commercial business. That part of the company exploded by 121%. Just wow. This is the side that works with corporations, not governments. And seeing it take off like this, that's a massive part of their pitch to investors, about long-term diversified growth.
And this really puts their performance into perspective. You see, in the software world, there's this benchmark called the Rule of 40. Basically, you just add a company's revenue growth rate to its profit margin. If you get over 40, you're considered elite. Palantir, they hit 114. 114! As the CEO himself said, that's just not normal.
So just so we're all on the same page, the Rule of 40 is a really key metric for these software companies. It's all about balancing a crazy growth with actually being profitable. Hitting 40 is good. Hitting 114, that's practically unheard of. It tells you that this is a company that's not only growing at a blistering pace, but is also incredibly profitable while doing it. So, what in the world is behind this?
Well, if you ask Palantir, the answer is one thing and one thing only. AIP. That's their artificial intelligence platform. They're basically saying it's the engine driving this entire surge.
Palantir is making a really interesting argument here. They're saying, look, while everyone else is just talking about the promise of AI, simple chatbots and what might be possible someday, our platform, AIP, is already out there in the real world delivering huge, measurable results for massive companies today. They're really trying to shift the whole conversation from what AI could do to what it's doing for their clients right now.
And they gave this perfect example of how it's happening. Picture this. A medical device manufacturer signs a deal. But then, within just a few weeks, the conversation goes from some single department all the way up to the CEO's office. And the result? The contract's value multiplies by 8. 8 times in just 5 months. Why? Because the entire company is now being rebuilt around their AI platform.
And that right there is the key. That's the real story they're telling. This isn't just some IT project anymore, something delegated to a back office. CEOs are now personally getting involved, driving their company's AI strategy because they see it as a total make-or-break issue. And that's why we're seeing these enormous deals happening so incredibly fast.
But of course, you really can't talk about Palantir without talking about its, let's say, very outspoken CEO, Alex Karp. His vision is a huge part of the company's identity, and boy, was he in rare form on that earnings call.
You see, he doesn't just run a tech company. He positions it as a cultural force. He openly draws a line in the sand, framing Palantir as this patriotic, anti-woke outlier in Silicon Valley. He's explicitly aligning the company with the U.S. military and a very specific set of values.
And he is not afraid to take on his critics, not at all. He basically says that the disruptive power of AI, which he calls positive destruction, is going to completely silence the skeptics. He really sees it as a fight against an elite class that just doesn't get what Palantir is all about.
So what's at the core of this whole vision? It's this idea that Palantir's AI is here to empower the everyday American worker, not just some tech elite in a high-rise. He points to stuff like their training programs for frontline workers and argues that their software makes a farmer in North Dakota or an engineer in Louisiana even more valuable by amplifying their real-world, hands-on expertise. It's a very, very populist take on what AI can be.
Okay, so that's the hype.
It's a powerful story, and it's backed by some truly incredible numbers. But now, it's time for the fine print. We're going to switch gears and take a look at their official 10Q filing with the SEC, which, let me tell you, paints a very different, much more cautious picture.
First things first, where is the money really coming from? Well, despite that explosive commercial growth we were just talking about, government contracts still make up over half, 53% of their total revenue. And the U.S. government is, by far, their single biggest customer. This reliance on government spending is a theme that comes up again and again when you read their own risk assessment.
And yeah, the 10Q lays out a whole lot of those risks pretty clearly. They're very open about the fact that just a few big customers make up a huge chunk of their revenue. They also point out that government spending can be super unpredictable, and this is a big one. Many of their contracts can just be canceled, for convenience, with very little notice. You add to that the risks of bad press or their reliance on cloud providers like Amazon Web Services, and you really start to see the other side of the coin.
So, how do we make sense of these two almost conflicting stories? On one side, you've got this high-flying, world-beating earnings call, and on the other, you have the grounded, risky reality of the SEC filing.
Let's lay it out side by side. The earnings call story is all about unprecedented growth, visionary leadership, tech dominance, even a cultural movement. But then the 10Q's fine print, it's all about customer concentration, cancellation risks, geopolitical uncertainty, and market volatility. Two sides of the same story.
So, the bull case, right? The optimistic view is that Palantir is simply the right company with the right tech and the right vision at exactly the right moment in history.
But then, at the very same time, the company's own legally required disclosures are a crucial reminder that none of this success is guaranteed. It all exists within this fragile ecosystem of very concentrated customers in a really complex global landscape.
So what's the verdict here? Is Palantir's unique blend of high-tech and fierce ideology a new blueprint for success in America? Or is it a really high-stakes gamble that could just as easily fail as it could succeed? The numbers tell one story, the fine print tells another. And the truth? Well, it's probably somewhere in the middle. It really makes you think, doesn't it?